Okay. Should this time go? Should be. Yep. All right. So our live. Thank you so much, David, for joining us today and offering us this real estate taxes. Just to start it out, I always started out by saying it's a great day to be squared away. We are here with Estate Squared Away's community estate planning online. So we're going to be trying to do this every month, and it's going to be a section on education. Yeah, David, thank you so much for coming, man. And we're going to learn about taxes, right?
Oh yeah. Oh yeah. Tax.
So,
And a bit of accounting, and I'll make the differentiation as I get into it. So.
That's awesome, man. So you're a CPA, correct?
Yes, I'm a CPA. Been doing taxes for maybe going on 20 something years now. I specialize with high net worth individuals with a focus on real estate investors. Spent a little time in the Big Four with Ernst & Young and PwC. Currently, I work at a nationwide firm experiences, and real estate has kind of my interest as it relates to taxes. I've owned a couple of properties. At this point in my life, I'm getting serious real estate investment initially my day job as a CPA.
Awesome, man. It definitely seems like you're busy, man. Especially during this time. So really appreciate you coming to talk to us, man.
I appreciate you having me on it.
So the way I wanted to start out is by asking kind of some basic questions to start out. Kind of the same thing everybody is wondering, right? Let's start out. You get a new investor that comes to you. They're like, "Hey, I just what do I need to bring to you to be able to properly do my taxes?"
Yeah, that's always that's always the question. And the first time people go through it, it's a disaster generally. Disaster because you're not exactly what to keep. I've gotten literal garbage bags full of receipts. Shoe boxes are very common.
Oh, wow.
I don't want any of those. I don't want anything to do with any of that. So I'm gonna start this off by saying the first thing you should do is you should get yourself an account. With that being said, most people who are starting out, it may be a little bit prohibitive cost wise. I like to think of it more as an investment. If you're not at that point where you feel like you can hire an accountant, which will probably run you somewhere, around maybe $2,000 to $5,000 per year. Where they're doing monthly books for you. They're monthly. They're getting your record. They're keeping your records in order, and then for tax time, it's really easy. So if you're not going to do that, the next best thing would probably be to get your a quick line subscription. That'll cost you about $15 per property. So it's not really that bad. It is a bit of a learning curve on how to enter things. However, QuickBooks is very user friendly. It's built for non-accounting professionals. Us accountants, we use it as well. But non-professional accountants can get it done. So the first thing I recommend when people are setting up a real estate business or any venture is to create a total bank account. So a lot of times people will come to me and they'll have their personal bank accounts, they'll have McDonald's and their child care, and then they spent $30,000 on rehabbing a house, and they say, "Here are my bank statements. Go through these." They're talking to me and pull out what's tax deductible. Well, I have no idea because technically anything could be tax deductible. The McDonald's could, in theory, be tax deductible. Probably not, but it could be. And so I usually push back and say, "There's nothing I can do with this. You're going to need to highlight what is directly related to your business and what's not." So the first thing I recommend is, and this is for any business, real estate, whatever you're going to do, you should have a bank account that only does business transactions. It's your bank account, but it's a business account. So you have the right to take money out of that account, but I wouldn't use my debit card to make personal expenses. You can make withdrawals, that's fine. I wouldn't make any deposits in there that weren't business income related. And generally, what I recommend is actually two bank accounts. You have a revenue bank account. All of your rents and any of your income goes into that account, and then you can transfer it out immediately into your expense account. And then in your expense account, you run your expenses through that. With the revenue account, if you only put your rents, no matter how you get them, and they go right into that account at the end of the year, it's really easy to determine what your revenue were. You just look at that account, look at all your debits, and say, hey, this is how much I pulled in. This is my income. You don't this minimizes your need to track everything, which is the best way. But this is a way that works as well. So in your second account, you have your expenses. There should be no personal expenses. No, not single, nothing.
So no personal expenses.
Everything in there should be business related. At the end of the year, you can also say, hey, everything in here is business related. All we have to do now is categorize it and get it done. You don't have to determine whether it's personal or not. Obviously, most people, don't have necessarily the cash in the bank to handle it off of the card. So that a lot of times they're using a credit card. This is perfectly fine. It doesn't have to be in a business thing or anything like that. However, if you're using a credit card, you want to have a dedicated credit card. So only things on there are business expenses. These aren't required to do this. It just makes things easier for you and therefore easier for your accountant, which in turn makes it cheaper. When someone brings you a shoebox, a $1,000 return becomes a $3,000 return. Most punitive reasons. Hey, all right, you bring this, I'll do it somehow, but I'm gonna charge you. I'm gonna charge you what you would have had to pay an accountant to do it all year because you give it to me now. And I'm going to charge you for the tax return. If you bring me an Excel spreadsheet that says, hey, this is how much I spent on this is how much I spent on this is how much I spent on this, I don't need receipts. Your accountant doesn't use receipts. Receipts are there to kind of verify things. And if you bring me that Excel spreadsheet or a QuickBooks report at the end of the year, I file your taxes, you can take a $3,000 return and make it $700. And so there are cost savings. And then there's also the effectiveness of being able to actually determine what you spent and where you spent it, which is very important when you're running a business. You want to be able to look at it and then you want to say, hey, this is where we are. This is where we're spending our money. These are the categories where things are, where we're spending most of our money. Let's investigate. If you find there's an expense category that's accounting for 20 or 30% of your costs, that's a category you want to really keep close an eye on, right? If it's % a year, keep an eye on it, but it's not that big a deal. There's no real cost savings you can have. But if you're spending 20% in the category, that's a category you want to say, hey, is there any savings here? Can I knock 5% off of this? But you need that information in order to make those type of determinations. So having the two separate bank accounts is a great way. And then having a separate credit card, it could be a personal credit card, it could be a business name, or it could be your name. But that you use this dedicated only to business expenditures. Go ahead, Angela.
Oh no, you did exactly what I was just about to do. Just a recap. So you're saying, just plain and simple basics of real estate taxes 101. You're opening your own bank account. You're creating something where it's only business expenses, like even including a credit card if you plan on doing the credit card, right? And then you're saying don't keep things in physical copies. Make them online like QuickBooks.
I mean, the physical copy is fine, but I mean, in this day and age, electronic is better. Electronic allows you to store it as a PDF. You can then store it with your tax return. Back in the day, you would have a paper copy of your tax return. You have a box full of receipts, and if you were audited, you would bring the box in. You have everything. Now, you should be able to create a folder with your desktop that says 2021 taxes or 2023 taxes. Have a folder with your tax returns and a folder with your documents. And then, you can easily go through this stuff. As far as QuickBooks, one of the real big advantages of QuickBooks is if you do have that dedicated bank account and you do have that dedicated credit card, you can link QuickBooks, and whenever you log in, you can just tell it to pull transactions, and it'll pull all the transactions from the bank account. It'll pull all the transactions from the credit card. First couple of times, you'll have to program it. Not program, but you have to tell it, oh, this is this, this is this. But the time it sees it, it'll put it right back in that category. So the first time you have a transaction from, say, Joe Dirt, and he does your maintenance. You say, Joe Dirt made my maintenance. The next time QuickBooks sees a Joe Dirt transaction, it'll automatically put it in maintenance. Say, hey, does this belong in maintenance? You know, yes, that's where it goes. So eventually, you'll have a Joe Dirt transaction every month, and when you link your bank account, you pull it, QuickBooks will put it in there, and then you'll just have to do a little bit at the end of the month, or even at the end of the year. It'll do a lot of that stuff. Man, that's one of the real advantages of QuickBooks Online. Once you get it does it automatically. Some of the stuff you can figure out on its own, right? But it'll pull stuff automatically. One of the real big advantages, one of the really cool things on reports. As you guys know, whether you're in the game or you're getting in the game, uh, uh, real estate isn't really about taxable income. It's really about cash flow. Cash flow is the most important. And the reason that is because this is one of the last real tax havens for the ordinary person is real estate because of the particular depreciation. Depreciation is that it's a non-cash expense, so you don't have to spend any money, but you get a huge deduction for it tax-wise. But if it's been in real estate or people who get in real estate, what you realize really quickly is your cash flow is what's. So when you're looking at a property, you're analyzing the property not based on saying, oh, it'll be, I'll make $5,000 per year. Well, how much cash flow do you have? You have a profit of 5,000, but you have a negative cash flow. That's not a property you want to get into, right? Mm-hmm. So real estate is one of those things, or you can have a loss. You can have a tax loss, and that's generally what you have, especially in the early going to real estate. You'll have a tax loss because you'll have large depreciation expense. But if you have a positive cash flow, that's what you're looking at. QuickBooks allows you to do a quick cash flow now. Where am I? What's going on? What kind of cash flow am I having? Am I bleeding, or is it a positive cash flow, and are things going great? So being able to do those kind of analysis on the fly, you should be looking at those things at least quarterly. The larger your portfolio, the more you can kind of look at them. But if you have one or two properties, quarterly is probably sufficient, maybe even semi-annually, as long as things are systematically going in order. And QuickBooks really allows you to do that.
So,
and I'm going about $15 per property.
So one of our members here, Yayera, she was asking, with QuickBooks, there seems to be a few different options. Are you seeing everybody pretty much turn in like the self-employment one, or is that sounds like it might be based on your structure, right?
Yeah, they do have some options. The one I was referencing was the self-employment one. It allows you to do one property basically per subscription or whatever. You can buy a larger QBO grander pack, and it will allow you to add as many properties as you like. It gets to be a little bit more expensive. If you have like one property, you can just buy the self-employment version. But yeah, they do have more robust tax that are more expensive. But then you can always upgrade and kind of enhance it. What I tell people is really give it a try. If you're not hiring an accountant, you should commit maybe 10 hours per month to doing accounting. So really, you're looking at 2.5 hours per week, which is not a lot. But what ends up happening is you don't do it, it gets backed up, and now you're 3 months behind. And instead of 10 hours, now you're looking at 20 hours of work, and you're like, oh, and then it becomes overwhelming. And I understand. I do get that. If you're going to be in business, there's going to be things that need to get done. Accounting is one of those things. And so you're either going to have to do it yourself, or you're going to have to pay someone to do it. But you cannot not get it done. So there's only two ways. You do it yourself, or you pay someone to do it, and that's everything that you're going to have in business with real estate, obviously. And if you're going to manage your property, or you're going to pay someone to manage. You're going to either be a plumber, or you're going to pay someone to do the plumbing. It has to get done. And the longer you push it off during the year, the more expensive and more onerous it becomes at the end of the year when tax time comes. And then it's just more of a headache. So it's just like anything else, entrepreneurship. is where we want to go. Also, learning how to do these things it has value. You know, even if you don't intend on continuously doing them in the future, learning how to do them adds value to your business, and then these lessons you can apply to any
Yeah. So, there's a really good, kind of controversy in the group, and it's a friendly controversy, where some people like the idea of not necessarily making an LLC or making some type of legal structure and just having it underneath their name. So, if I was to ask you, what are you seeing most common with these investors? Are they putting themselves underneath an LLC? Are you seeing people protect themselves in specific ways? Kind of structure.
So historically, real estate was held individually, outside of any corporate structure, and even currently, C corps and S corps aren't a great way to hold real estate. But with the explosion of the popularity of LLCs have become a very popular way for people to hold real estate. So I'll say this: there are no tax differences. Any tax deduction you can get as an LLC, you can get as an individual. There are no tax differences. The differences come down into an LLC is easily transferable. You can just shares. You can take on investors. Let's say your brother-in-law comes up and he's like, "Man, I got $100,000. You have a property already. It'd be easy enough to take this $100,000 and share the LLC. It'd be a lot more difficult to maneuver if you own the property outright. Now you have to come in and say, "Oh, I want to put them on the title and all this kind of stuff." Whereas if you comes in as an LLC owner, the LLC is the owner, is the title holder of the property. You simply sell the shares. Uh, the common misconception, and why a lot of people who aren't familiar, like to get LLCs is because of the idea that it's a limited liability. So, I have liability protection. That's true, but it's not what people think. So, a lot of people think, "Oh, I'll get LLC, and if something happens to my property, people will sue my LLC, and I'll be okay." That's not actually how it works. If, in the sense that if you get an LLC and decide, "Oh, I'm going to minimize my insurance coverage," if they sue you, your LLC, and you don't have enough coverage, they can still come after you. There are ways where a lawyer can go past that if they're proving that you're diligent, that you have this liability protection. So if you have an LLC, you still need the same amount of insurance coverage to cover yourself from liability. Um, and if you don't, there's the possibility that a court can find you negligent, and in the sense that you were attempting to minimize your insurance burden by buying this LLC. So it's not a replacement for insurance. If all your other ducks are in, it is a protection for the rest of your life. So if you have, what I see is one of the things that they have is called a series LLC. So you create a master LLC, and for each additional property, it's LLC, but it's a sub LLC. So it's a separate entity under the master LLC, and it's called a series LLC. So this is kind of a cool little thing. And so for every property you buy, so you buy a property on 115th Street, 115th Street LLC, 120th Street LLC, and then your master LLC is LLC or whatever you name it. That name is irrelevant. And you can roll out LLCs. It's a little bit cheaper as far as that's not really my area. We need an attorney to talk to about that. But what it does is, if your other stuff is in line, if your insurance is in line, and things like that, and your paperwork is in line, and you think that you need to do as a corporate entity, if one of your buildings does have a liability, you'll just lose that building. So just be, "Oh, I'll just take my finger off," take your own hand, and it won't be associated with the other. It does provide. That being said, I'm a CPA. I do work with that, and I see a lot of that. But this is more of a legal question. From a tax perspective, the IRS doesn't care if you're an LLC individual. I mean, you have to designate as such, but you get all the same tax breaks. And if you're a Single member LLC, that's what's known as a disregarded entity. So if you're the only owner of an LLC for tax purposes, you don't have an LLC. You just file it as if you were an individual. You say, "Oh, this is the LLC" and all that kind of stuff, but you just file it on your personal return. If you have multiple members in your LLC, then your LLC has to file a tax return, partnership tax return. They issue K-1s to each of the members, and then you put your stuff on your individual tax return.
So, a couple of questions here. So, Jen B, she's saying, are there any tax advantages to investment properties in a trust? What do you know about trusts? Oh, was there a question? Somebody sounded like they were going to ask something.
Okay. Trusts are, I guess. Well, I do quite a few trust returns. So I do a significant amount of trust returns. You don't tend to see as many properties in trust. The thing about properties in trust is, for you want to pass to your children, or you kind of create the separation. The downside to trust return, to trust, is that their tax brackets are more narrow. And let me explain what I mean by that. So for an individual, first, you get out of the 15% tax bracket at like, I don't know, 30,000. Let's say 30,000, just for math's sake. I don't know the exact numbers, but that means that your first $15,000 in taxable income is at the 30% tax bracket. Trusts run through the 36 tax bracket at like $20,000. Their taxes are much more narrow. You end up paying a lot more taxes way quicker in a trust. It's the penalty of a trust. So people with trust, who have trust, tend to be high net worth individuals who have other purposes in mind other than tax savings. They have estate planning reasons. If you have a trust that's known as a non-revocable trust, established trust, there's no way to get the money back out. It removes that asset from your estate, and it's no longer considered your asset. You can still kind of control it. You can be the trustee of it. You can even be the beneficiary of it. But if you were to die, it would no longer be a part of your estate. So trusts are used in that sense. Again, this is more of a legal concept than the tax concept. But from a tax perspective, trust, the thing that you want to be aware of is that trusts have a tax advantage. They reach the top bracket way faster. The 36% tax bracket for an individual, I think you reach it at like 400,000 or something like that. It's like 350, 400,000. For a trust, it's something like $20,000, $30,000. Tax income, you reach that top bracket. So it happens really quick.
Wow. Brad T, we got a couple more questions. So Brad T said, one note on LLCs is that if you are planning on using, okay, so this is a statement, I'm sorry. If you're planning on using hard money, the vast majority of hard money lenders will not lend to you personally, only on LLC or other corp entity. So that sounds pretty, that's a good point.
Yeah, and I'm finding that to be similar for the DS loan, the debt service loan. They're interested in loaning to LLCs. They don't have a hard and fast rule, but they recommend that you go to the LLC. And from my buddies that I talked to about hard money, they do want the LLC. So it doesn't hurt you to have the LLC in that sense. It does create some additional paperwork, some additional costs, and some additional administrative tasks that you need to take on. But there are some advantages as far as transferability, reaching out to investors if you're doing hard money, being able to have that like that, yeah. And then a lot of times once you get that up and running, you can get your mortgages on the LLC, and they'll be kind of off your books. That's going to depend on what type of mortgage you have. Some mortgages, whether you have an LLC or not, they're going to still want you to give your credit report.
So Pippi said that he's going into a partnership 50-50. He wants to know which way would you recommend? He's saying, should he go S corp maybe?
Not for real estate. No.
Hmm.
No. Don't hold real estate in an S corp.
Okay. Okay.
That's just that's just an old rule. It's not impossible, but just as a general rule, real estate and the S corps aren't recommended. An LLC would be a great way to go. LLCs offer a great deal more flexibility than S corps anyway. S corps can be really beneficial if you're running a business. Uh, and this is a tangent, but because you can avoid some of your self-employment tax, right? So if you have a business and you're running an operating business and that income is earned income and it's going to be taxable for self-employment, that's like 15.5%. You can move some of that to S corp distributions. It won't be subject to self-employment tax. It will still be subject to the federal and state income tax, but you can save 15%. So on $100,000, you can save $15,000 simply by starting an S corp. However, real estate isn't subject to self-employment tax. The income isn't subject to self-employment tax. There are the flexibility on corp is limited. With an S corp, with an LLC, you can be 50-50 shareholders, but you could say, hey, John gets 30% of the income, and Chris gets 70% of the income. With an S corp, you get one share of income per share of stock. So there is no, you can't flex it. The only way to change it would be to give one person more stock, or yeah, on a yearly basis. But in an LLC, every year you can say, okay, this year Chris gets 50, and John gets 50. And you can change it every year. There's a great deal of flexibility in how you can allocate income, how you can allocate expenses when you have an LLC partnership. So that and that's one of the reasons why it's becoming a very popular form for both real estate and for businesses, because of the great flexibility. The administrative burden isn't as great as sports. One of the downsides for a lot of people starting out in business, I have to really caution, if you don't do APC for an S corp, and you get sued, and the corporate veil, that's what it's known as, pierce corporate veil. Okay, you ANZ all three of these in the time it was supposed to be done. Therefore, you didn't have a corporation at any time. And at that point, the you know, at that point you're losing because you're being sued. And now they're saying, now we're coming after you personally. So LLCs don't have as strong of administrative burden to prove that you were operating as a business. FYI, just so we're clear here, I was talking about having separate bank accounts before. If you have an LLC, you have to have. You don't do any commingling when you have a corporate structure. There should be no commingling, and it's legitimate to take money out of the business, and it's legitimate to put money into the business. But what you don't want to do is use your business bank account, have your business debit card right next to your personal debit card, just choose whichever one you use for expenditures. That's what you don't want to do. But it's perfectly legitimate to say, hey, my LLC is short of cash, here's $10,000 for my person. You just make a $10,000 transfer. Or my LLC has plenty of cash in it, and I want some cash in my pocket, and you make a transfer from your LLC to your personal account. But you don't want to use it as your own account. So if you have an LLC, you got such a bank account, and you have to treat it as if it's someone else's bank, because it is. It's the LLC account.
So, what is your experience with foreclosures and tax sales? Because I know some of our investors are planning on going that route, picking up some properties through tax sale and foreclosure. Yeah.
Foreclosure, not a ton of experience in that sense. The thing about, I mean, it's just a question of finding it. With that, you're working more so with the bank and trying to make a deal. So I mean, I don't have anything to say about that. The tax sales are an interesting thing, right? So with the tax sales, you have two types of investors. One of the things about tax lien certificates is it's not a guarantee that you'll get the property, and some investors don't want the property. Is for the owner to pay the taxes, and then they get the taxes and they get the penalties. So the county sells it, you buy it, the person comes in, pays off the taxes, you get the taxes that they paid off because that was the principal. But then you also get the penalty, the fees that they were charged, and that's your interest, and that's what you earn. And you can earn 15, 20, 25% with that. And some people use tax certificates in that fashion. Other people use tax certificates with the hope of buying a property on the cheap, buying a certificate on the cheap, and then being able to take the property. What I can say about that, again, this is an attorney thing. And if you're going to get into tax liens, the first thing you want to do is get an attorney who's familiar with tax liens in your county. It's going to cost you money, but it'll cost you money not to. It'll cost you a lot to do it. But people got to learn their lesson their own ways. But so when you get the tax lien, if you're looking to say, hey, I want to buy some tax liens, I'm going to hold them, and then I'm going to take over the property once I'm eligible. What you got to understand is from county to county it's going to vary, but in general, the taxpayer needs to be several years behind, 2 or 3 years behind, depending on where they're at, before you can take the property. So when you're going in, you need to educate yourself on, well, how many years the tax certificates do they need to be behind? You also, need to understand, hey, are other liens on this, right? Because in theory, there could be a mortgage lien on that property, right? And then, and this isn't tax. It's just my personal experience working with people things like that. You got to understand, is there someone living there? Because now you're looking at evicting a squatter, essentially, right? And as I'm sure people have heard, that could be a not in the sense that that person may actually have rights, ironically enough, uh, to that property. And there's a lot of talk about this online about whether it's right or morally right or wrong, but a lot of that stems from our historical English backgrounds and also it was held up in America as a way to expand the country, homesteading and things like that. So there are reasons why those laws exist. They just haven't been removed from the books. And in our present society, it seems like why would we ever have those? Well, those have existed for centuries for a reason. So when you're in the tax system, you have to consider that. So these are things that you need to educate yourself on. From a tax perspective, um, if you're gonna, let's say you buy a property for, I don't know, $4,000. I was looking at a property, the guy bought it for 7,000, had it listed for 70, and didn't do anything. It just happened to be in the right place, and it was probably worth 70. It needed a lot of work, but the location was, I'm not sure if you're familiar with the Gary area, but it was only less than half a mile from the beach over in the Middle Beach area. It was beautiful. I was considering purchasing it myself. But there was a little bit of a part of me that was kind of upset, like, damn, paying a real premium. It was actually a pretty decent deal for the house, but I was a little bit kind of salty that he paid $7,000 in a tax sale. But from a tax perspective, if you buy this property for $7,000 and you sell it for $70,000, he has a $63,000 tax gain. They ought to pick up. If he held the property for a year, it would be a long-term capital gain, taxed at 0, 15, or 20%, depending on what other kind of income you have. And if you buy the property and fix it up and then hold it, you'll be able to depreciate the amount of the cost of the tax certificate. That'll be a part of your basis. And then the improvements obviously part of your basis. There is some money to be made there. It's not necessarily quick. It's not necessarily quick because even in the best case scenario, it's going to probably take you at least a year. And most importantly, you can't miss a single deadline by an hour. Or the county will just take. I mean, not at all. They're hoping you miss a deadline by an hour, and then it's a wrap. So that's why I recommend, especially if you're just going to be starting out, talk with an attorney. Hire an attorney to work with you on getting this done. It's a paperwork game. Tax certificate is a paperwork game. So you have to make sure that all your paperwork's in order. And in that sense, I would definitely work with an attorney who does these type of things in your county, specifically in your county.
Yeah, so Jen has a really good question, and I was kind of wondering this too. So she said, could the Miller Beach investor, could that Miller investor avoid taxes using a 1031 exchange? What's your experience with 1031 exchange?
Man, I just spent 20 hours working on a 1031 exchange return this year. It's a great feature. It's a cool feature. So for everybody that doesn't know, whenever you hear those numbers, what that means is that's the tax code. So one that everybody's familiar with is 401k. That is literally the 401k section of the tax code. So if you're looking for it, you can go to section 401k and find it. So 1031 is the tax code 1031. So the way that works is generally, let's say you buy a property for $100,000, you sell it for $125,000. You have a $25,000 gain. You have to pay the tax on the $25,000 gain. So you can pay the tax and move on with your life. Or say, hey, you know what? I am going to go buy another property. How about I don't pay you that tax right now? I pay the tax later. So the 1031 exchange code allows you to trade what's known as like kind property. So you can trade houses for houses. They can be residential or commercial. You can trade cars for cars that are investment. You can trade machinery for machinery, but it needs to be like kind. So trading a car for a house isn't like kind. There are some ways around that. Like, let's say you have a business that includes real estate and it has machinery. You can trade all of that for a commercial property, and you can make some arguments that it was all like kind. So when you trade it, this again is a very has to do everything in proper order or it eliminates the whole deal. So it's a great deal in real estate, especially as you're building your portfolio. Because what you get is you get the benefit of using those tax dollars instead of paying let's say you have $100,000 gain, right? And your tax is going to be $20,000. Instead of giving the IRS that $20,000, you say, let me hold it. I'll put this $20,000 back into another property, and then sometime down the road, when I sell that property, I'll pay you, or I'll 1031 again, and I won't pay you then. But eventually, I'll have to pay you if I sell. Right? So the way it works. Okay. So let's say I take a property, I have a $25,000 gain. Instead of paying the taxes on it, I then go out and use all of that money to go buy a new property. So the first thing you have to do is you have to identify the next property within 45 days. Generally, you already want to have an idea of what the next property is going to be prior to selling the first property. From 45 days from the time you sell the property, you have to identify a new property. There's a little wiggle room, like you can identify something happened, you kind of change it. But in general, you need to have that property identified in 45 days. And then you have 180 days to close on the deal. A lot of people structure their deals contingent. This gets a little bit troublesome because a lot of sellers aren't interested in the contingency on saying, "Oh, I'll sell this property if I can find another property." A lot of sellers will be like, "I'll take a little bit less money to just close my deal." But there are more than enough sellers who at least entertain the idea. Which, as you can see, it can be problematic because then they're kind of waiting on you, and they could end up waiting a month and a half, and then you're unable to identify a property, and you're just like, oh, whole deal fall through. But it's a whole industry, so it works for people. So you have to identify the property in 45 days. When you sell property, you cannot take possession of the proceeds. You have to have what's known as an intermediary, and these are companies. There's a ton of companies out there. They set up the exchange. They charge you obviously for this. And they take proceeds. So essentially, they do the transfer. They never hold the property. They never own it or anything like that. But they do hold the money in escrow. You can't get the cash. They hold the money in escrow. You have to identify with them the property in 45 days. You let them know the property. And then within 180 days, you have to purchase the property. And then they distribute the cash closing to with the new deal. And on your HUD, you'll see it. It'll say intermediary dispersed $125,000. If you do it properly, even if it crosses over years, like if you start in December and it crosses over into January, you won't have to pay any tax. You do have to report. And like I was saying, I just spent a good 20 hours just tagging on a single one, where a lady sold 7 residential houses. It was all on one plot. She sold it all to one person and flipped into a large commercial building. And so she had a $325,000 gain, but she didn't pay tax. She didn't pay tax on any of that. She flipped it all in there. Now, that tax doesn't disappear. It simply reduces your basis in your new property. So let's say you have that's how they get the tax. That's how they get the gain back, right? So let's say you have a $25,000 gain, and you flip it into a new property, and the new property is $100,000. If you went out and bought a $100,000 house, your basis is $100,000. But if you took 1031 into a $100,000 house and you had a $25,000 gain, your basis is $75,000. Because of the $25,000 built-in gain, they just reduce your basis. So it reduces your depreciation, your depreciable base, and in the future, when you sell that property, that $25,000 is already built in there. That $25,000 gain is already built in there, and so they then get their money on that $25,000 as additional gain. But in theory, you can continuously 1031. You can do any 1031s that you want. FYI, you can 1031 life insurance policy. So there are you don't see that a lot, but I have seen it enough. So 1031 any business property. So if you have a business, real estate is a very common way to do it. Like I say, life insurance, annuity contract, the way you do it.
Okay. Hey, how you doing, Chad?
But it's a great way when you're building up because you can. It's essentially like having a 401k where you're not paying the taxes, you're paying the tax later. Come on.
Okay. Hey, Chad, can you mute your mic for me, man?
Oh,
hold on. Oh, perfect. You got it. All right. No, that's awesome. So let me ask you another question, right? This is a good question about, the transfer of ownership. You're Chad. So what about, have you seen people that either have tried to do option purchase, seller finance, or just paying over time? And what do you know about that as far as how like income tax is affected?
So in a weird way, ownership and taxes are not as related people think. So in the sense that, for instance, I could rent a building and make money on it and never own it, right? Like you guys are seeing like that arbitrage concept in Airbnb where they take a lease and then they rent it out to Airbnb people and but they never own the property. So ownership is a separate issue from tax. Taxes simply say how much money did you make this year and where did you make it. We don't really care. I mean, in theory, they don't even care if it's illegal, right? I mean, Al Capone went to jail for tax evasion. What they said was, if you had just simply reported all this gambling and prostitution and liquor money, you wouldn't be going to jail for tax evasion. He would have gone to jail for alcohol, prostitution, and racketeering, but he wouldn't have gone to jail for tax evasion because he would report it. So as long as you report it, the IRS is like, you're cool with me. But then the FBI came in like, hey man, you just reported having all this illegal gains, taxes. So the IRS, you're cool with the IRS, but as far as illegal, we're going to take you to jail. So I say all that to say, there is a separation between ownership and taxes. If you make income, however you make it, the IRS wants their piece. No matter where you are in the world or no matter what you're doing, they want their piece. How you own the title, that's not really that important. Like if you do a seller finance, I've seen, where you're involved in seller finance where they don't transfer title until after you make your last payment. But you have control essentially of the property. So you can rent it out, you can live there, you can do whatever you want. So for tax purposes, you can you're still paying taxes. One important note is that the thing that people often run afoul of is seller financing and thinking that if it's for a personal property, thinking that the interest is automatically deductible. And that's not the case. In order for it to be considered a mortgage, it has to be perfected as a mortgage. And this is a legal thing again, and arbitration, all that stuff. So simply saying, hey, I'm gonna buy this property from you, and he's like, cool, I'll hold 100,000, you'll pay me 10,000 a year or whatever, and I'll charge you this interest rate. That interest doesn't automatically become deductible unless you're renting it. If you're renting it, it doesn't have to be a perfect mortgage. For a business, you can pretty much anything you spend on the business, anything legal, is deductible. It doesn't need to be perfected. If you want to if you do this is just a note. If you do it from a personal perspective, the mortgage has to be perfected in order for you to deduct it on your 1040 individual income tax return. However, if you're renting the property and it's a rental property and you're using a Schedule E, which is the form that you would use for rental properties, you could pay a loan shark interest, and that would be 100% deductible. Of the note I made earlier, if you run expenses from your LLC on your credit card, that interest is deductible. That's a tax deduction, and that's one of the reasons why you want to keep it separate. Even if you commingle it and you run all of your expenses on the credit card and all of the business expenses on the credit card, it's not recommended. But then you can bifurcate that at the end of the year and say it's 50-50. You can take 50% of the interest at the business. So there's, the IRS is like, man, tell us how much money you made, tell us how much it costs you to make that money, and pay the difference in tax. With real estate, one of the really, beneficial things is that you can still take losses and deduct those losses, assuming your outside income doesn't exceed about $150,000. You can take those losses, and then if you are in the game of real estate, like that's all you do, like Angelo, you're a real estate professional. If you begin to own real estate, you can claim real estate professional. You can take an unlimited loan. For everyone else who has a day job, you have a W-2, a day job that's not real estate related. If you're in real estate as your day job, you're a real estate professional. But if you work, like I'm a CPA, I'm not a real estate guy. My real estate properties will be limited twofold. One, if I make over 150,000, I won't be able to take any losses from real estate. And if I make under 150,000, there's a limit on how much losses you can take per year.
So how many hours? I hear that there's a transition that some people like. I'm sure Mike is probably gets to that where they have so many properties, they spend so much time working with their properties. Now they're considered a real estate professional.
Yeah, and that the thing, the 150 mark. I believe that's MFJ. I can't say right now on the 100. I saw that question mark. The 150. I'm not sure if that area or that single. I can't say off the top of that. I can look that up and I'll shoot something to Angelo. That'll be a quick answer. Well, let me get back to that. Related to the hours, that actually is a point, right? To determine if you're a real estate professional, it's a determination of how many hours you spend per year in real estate. That being said, if you have another full-time job, the IRS is generally going to say you're not a real estate professional, even if you spend a ton of time in real estate. But if you all you do is real estate, if all you do is run properties, and if you're looking for deals all the time, if you don't have a day job, or you have like a part-time job where you work, make a few extra dollars or something like that, or maybe it's some kind of side hustle, it's a lot easier to become a real estate professional. The trick is that the hour limit is actually per activity, and each property is its own separate activity. So I think the hour limit is, like 2,000. That's not a number, but let's just say that for example, it'll make sense. Let's say it's like 2,000. So for the most part, if you own like 15 properties, there's no way you can put in $2,000 hours per property, right? So what they have is what's known as a grouping election. What that means is you have to make an election, and you only have to make it once, But if you get a new property, you have to make a new election to add that property. And they'll add up the time from each property to meet the total time for the year. And you group it. You simply say, hey, IRS, I want to group all of these activities as one activity. And that way I can meet the threshold for the hours necessary. There are other reasons why you may group. There are other reasons to group activities, but in the real estate game, mainly group activities to meet the threshold to be a real estate professional. And the advantage of being a real estate professional is that you can take all of the losses on your property. As you get into the game, as you get deeper in the game, you'll see that there are, there'll be losses. And you take unlimited losses even as your income exceeds this limit. That's the real kick, right? So you can be a millionaire, a billionaire, and take full losses, right? This was one of the things that kind of came up with Donald Trump. They were like, "How's he writing off all this money? How's he writing off $300 million on losses and things like that?" He was a professional, in which case any losses he took was just like it's just a business law. For the most part, most small landlords and a lot of landlords in general are passive. They're classified as passive investors in real estate, and so there are limits. But with being an active real estate professional, they take the limiters off and they say you can lose as much money as you want. Obviously, you don't want to lose money, but in the real estate game, a tax loss is common. It's even desirable, and then that goes back to but you're still getting cash flow. And the cash flow analysis for people who don't know, you take all your income and you remove all the non-cash expenses, and you add in all the cash expenses that aren't tax deductible, and that gets you back to your cash flow. So,
yeah,
it looks like we're dropping off. So we got maybe a couple more minutes. We got a couple more questions or anything.
Yeah, we'll try and finish out the hour. We'll have a full video. My next question for you. This is really interesting. A lot of our group and like Mike and the OREC group, they kind of preach this idea of no appliances in the rental properties. Now, I heard that you guys can actually like count that as depreciation alongside your taxes, and that might be a benefit to actually offering appliances.
The offering of the appliances, the downside, obviously, and this is a real estate thing. This you guys are probably more versed in this than me. But what, from my understanding, is breaking. Right? If it breaks, you got to fix it. Right? If you don't offer appliances, you don't have to worry about that. However, anything you do in your property is tax deductible. With the appliances, if you buy a stove, you get to depreciate that stove. It's over, I think, 5 years. So if you buy $1,000 stove, you get a $200 per year. So yes, you do get the deduction. The downside is more of an operational question of, if this stove breaks down, I have to fix it. And so that might be a reason why people don't offer it. I think that from my experience renting, that's just going to be a question of what type of rental market are you in? Are you in the type of market where people want fully furnished apartments? They want appliances? Generally, if I'm renting, I'm going to need appliances. I don't have any appliances. I think long-term renters are, probably more likely to have appliances and want to put their own stuff in. But I think that's not going to be tax-driven. I think that's going to be market-driven, and just appealing to where you are and the type of renters you have. So the tax consequences are there. If you buy an appliance, you conduct it.
So you're saying that the depreciation is something when you purchase an item, it's not based on like wear and tear and the use over time and stuff like that.
Has nothing to do. Okay. Every single asset that you can think of, the IRS has already identified and given it a life, useful life. Cars are 5 or 7 years or something like that. It doesn't have anything to do with how long you can last. A house is 27 and a half years. Don't ask me why. Carpet is 7 years. Office equipment is 5 years. Computers are 5 years. And so they already said it. They already determined it. You buy an appliance, you pay $1,000 for it. It's a 5-year life. If it lasts 10 years, that just means those last 5 years, you're not getting any deduction for it. Now, from a business perspective, you're like, okay, that's cool because I got 10 years out of this stove. But from a tax perspective, you lost. I mean, not lost. You don't have any more deduction. But a lot of people try to wag the dog with the tail, and what that means is that they're like, "Oh, how can I save taxes?" Well, in the best case scenario, you're going to save 35%, right? So why would you spend $1 to save 35 cents? I don't like to lead the tax. There are things that you're going to have to do and structure in a way that can benefit you from a tax perspective. But I wouldn't go in to spend $1 to save 35 cents. And if anybody's interested, I'll take those deals. I'll give you $1. I'll give you. So if that's what you're into, I'll take. But I think a lot of people get kind of carried away and say, "Oh, there's tax savings. I should spend some money." Well, no. If you're going to spend the money, you structure it so that you save taxes. But you shouldn't spend $1 to save 35 cents. If you weren't going to spend that $1, put that $1 in your pocket and keep it. So.
Yeah, no, that's awesome. Hey, Hans, we got Senya back too. What's up, Senya? So, what was it? So, the next thing I wanted to ask you, what about property taxes? What kind of things? Let's talk about in this last 5 minutes the tricks, the tips, the things that you're seeing these investors do. Are they doing anything um deliberately? You know what I mean? Some people, they're like, oh no, keep the mortgage, transfer the like if you're doing a rehab, transfer the equity out and keep 1031 exchange, or doing that Burr method. You know what I'm saying? So what kind of tricks are you seeing?
Yeah. So, property taxes. I mean, like if you're in a rental property, there's not a lot you can do. Like, obviously, if you're an owner occupier and you're renting it out, you can petition to get homestead exemption and things like that. But property tax just ends up being spent. It's not actually an area that I necessarily hold on, because that's property tax and income tax. But what I can say from personal experiences is that a lot of times it may benefit you to pay that attorney to do, to contest your tax valuation. I know, the general way is on contingency. They'll take half of the first year's savings, whatever. So if you do it at the beginning of the site, you can benefit from those for 3 years. But there's not a lot there to do, right? I mean, the tax that you pay are deductible, and that's pretty much it from property tax perspective. Tricks, I think that
Real quick, sorry to interrupt you. Senya said that she had a question for you. Oh,
Your mic's on mute if you are trying to talk. I can't.
you got this.
Okay, she's not trying to talk.
I'm trying to.
Oh, there you go. Okay.
It's the last turn my mic back on. So question. I heard somewhere that to write off your investment properties, right? All the expenses from your investment properties. You can only fully do it if your W-2 income is at 150 cap a year, right?
Yeah, and I just mentioned that, right? I'll give you that. Yeah, it has to be under 150.
Sorry, I probably missed it. But I'm talking about if your properties are in your own name, not an LLC. So does it have to be 150? Like, is it capped at 150 income on your W-2, or like how does it work?
It's all your outside income, so your W-2, your investments, all that kind of stuff. Once that AGI hits 150, then your losses on your real estate are stopped, right? You can still offset any real estate, but you can't take a loss. But it doesn't matter if it's in an LLC or if you're holding it outright, because it'll all be considered real estate income. And I kind of went into this earlier. If that W-2 is from non-real estate related things, there's no way around it. But if you're getting a W-2 from a real estate type job, then you can possibly argue that you're a real estate professional, and then you can take unlimited losses. But the 150 is a hard cap. There's no real way around it. Now, in theory, if you were to have a W-2 and you had a business, and the business took a loss and it took you under the 150, it would also free up real estate losses at the same time, so you can get that rush. But obviously, you don't want to have a business taking a loss. But if you do, as long as your AGI comes under to 150, you can then start taking real estate loss. But it's really it is kind of limiting because once you start making money, you're like, oh shit, it's not impossible to make 150. It's not really that difficult to make 150 from your job, and now you got these passive losses. That being said, just so you're clear, let's say you can't take those losses each year, but if you were to sell the property in the year of disposition, you get to write off the entire amount of the loss on that property. So let's say you had a $20,000 loss years, you never got to take it, and then you sold it. Regardless of how much your income is that year, you get to take that $100,000 loss in the year of disposition. So that you do have that, but that 150 is a hard cap. And someone asked me, was that for married or for single? And I'm going to get back on that. I feel like it was for both, but that's not usually standard. They usually have a variance. I can't remember. And I mean, frankly, a lot of the clients that I work with right now, they may make $10 or $15 million, so they don't even qualify for that. So I don't have that in most time.
Yeah. So.
All right.
Sorry.
Thank you.
You're welcome.
So thank you so much, David, man. We have spent an hour. We are going through. It was a great questions from the gallery here. Thank you guys so much. And David, we're going to try and do this pretty routinely, I believe. Is that right?
Man, I'm around. I love this stuff. I can talk about this stuff all day. I'm not the best at keeping up with the chat. I see there's a lot of chat. I'll pop in from time to time. If somebody really wants to kind of, give me, they maybe just poke me and call my name or something like that. I'm really interested in being a part of the community. I have a lot of experience in the tax, but not so much in operations. So I'll have questions for you guys. I am in Gary. I was raised in Chicago suburbs. I just got back. I was living in Costa Rica for a while, and I'm getting into the game. Thank you.
Yeah. So
actually, I do own a property in Costa Rica, and it's amazing.
So you're gonna Airbnb, right?
I've been Airbnb-ing it. Just to give you a reference, I paid 85 cash for it. I grossed 35 last year, and I'm looking at gross about 40 this year. And I netted last year. I netted about 18, but it's 100% passive. That's after my management fees and everything. So I loved it. The city is called Puerto Viejo. It's on the south. It's on the Caribbean side. It's about an hour and a half from Panama. When I go down there, that's a 3. When I go down there, I can stay out. And I go to Panama. About an hour and a half for a party. It's a real chill city. I love it. It's my favorite place in the world. Costa Rica. But my new job back here, it did other Pura Vida. Other issues, flexibility. But that's neither here nor there. So I really appreciate you guys. I appreciate you guys having me. The question, and I love talking about this stuff, I love and I are going to be doing things together. So I'll be interested in working with you guys.
Yeah, exactly, man. We are going to be looking at trying to make something routine with David and get some knowledge directly from him. So guys, be paying attention to it. David, thank you so much, man. And thank you everyone for coming out.
Welcome, guys. Have a great day, man. Enjoy your rest of Saturday. I got to go back to work. It's tax season, you guys.
Take care.
All right. Bye.
Thank you.